Stacker here. Welcome to another Smart Silver Stacker live stream. Got a lot to talk about today. We have a brewing economic crisis here in the US, and I know there's a lot of attention being paid to the debt ceiling at the moment. And, it seems to be the view of many that if the president and the senators and the Democrats and the Republicans, if everybody can come together and just agree to borrow more money and spend more money, that's going to fix everything and that's going to avert this crisis. But there are several reasons why we should be kind of circumspect about that view, and we're going to get into them today. Also, I'm going to talk about the price action that we've been witnessing in the gold and silver markets because the pullback has been continuing. Now, it hasn't been a sharp sell off, but it has continued to drop day after day, the price of both of the precious metals. And if you are joining us today, I do appreciate it. Thank you so much for tuning in. Please do smash that like button, and we'll be getting into why an economic crisis is inevitable here in just a moment. You might notice that my voice is a little hoarse today. I am still fighting whatever this bug is, so sorry about that. You'll have to deal with my raspiness today. But that doesn't mean that I can't join you for a little while here and talk with you because it's one of my favorite parts of the day, and I think that this information is worth spreading. So let's take a look at the price of gold and silver and just see what they're doing. Gold down to 1949, silver under 23 bucks now. So, I was calling for a pullback a couple weeks ago. One of the big reasons that we've seen this pullback is simply a technical reason, and it's because the price of gold and silver, if you look at them on a 1 year chart, they had a big move up and they got kind of overbought and they needed to correct. And likewise, vice versa with the US dollar. The US dollar index had kind of precipitously fallen for about 6 months. And so, it needed to move up a little bit. So I do think that there is a strong technical component to this sell off. Some of the news today that we got that had to do with US GDP numbers, that caused a bit more of a sell off. Looked like the metals had some weakness. Oh, I'm hitting a paywall here. All right. Well, sorry, I had this article pulled up from Market Watch. Doesn't matter. I can just give you the rundown. We'll get that off your screen. Yeah, so the deal was that the US GDP numbers came out. They were revised higher for Q1, up from originally reported as 1.1%. Now they're getting reported as 1.3% for Q1. Big deal. Still kind of anemic growth, not surprising. And when you factor in all of the inflation and the other economic problems that we're facing, I wouldn't take this as necessarily a good sign. But when these numbers came out and when this revision occurred, the price of gold and also of silver did fall a bit. And so, that's what's contributing to a bit of the sell-off today. So a bit of a technical thing, bit of news. And one thing that we've been witnessing over the past several weeks, as everybody seems to be focused on nothing but the debt ceiling. I mean, that and Bud Light. I mean, those are the two things that everybody seems to be focused on. We have been seeing markets generally selling off, considerable weakness in the markets across the board. And gold and silver have been no exception. One exception that we have seen to that is some tech stocks. Tech stocks have done okay. Some of the really big mega cap ones, like Nvidia, for example. Some of these stocks seem like they're getting a bit of a boost from the potential gains that AI will contribute to their bottom line. So that is one bright spot in these markets. But in general, they have been suffering. And, there is some reason to believe that even if we get a deal in Washington to raise the debt ceiling, that is not going to fix things. And we're going to get into why in just a moment. I do want to talk briefly a little bit more about gold. So I view this, decline that we've seen in the price of precious metals largely as a buying opportunity. If you do want to get some gold or silver right now, this is a sale that SD Bullion actually doesn't have on their deals page. But if you navigate to the Silver Britannias, they've got these Britannias for $26.71, any quantity. So pretty decent price for a sovereign coin. So if you are looking to take advantage of this drop, that is probably going to be my pick. Not financial advice or anything, but I'm thinking of picking some of those up. Although I haven't even gotten my most recent order from SD Bullion of that kilo bar, so I'll be doing an unboxing for all of you when that arrives. This is another story related to gold. It looks like Poland is on the same page as me. They're viewing this dip in the price of the metals as a buying opportunity. They have now added 15 tons to their official reserves. That's the biggest increase in nearly 3 years. And I think that as this economic crisis that we're heading into continues to play out, we are going to see a number of countries continue this trend of stacking official gold. Uh, Going to the chat here real quick. Thank you everybody for joining in. Someone says they thought I was Silver Dragons with the hand movement. Well, yeah, I mean, we're both kind of hand models on our channel, I guess. So, no, I'm not Silver Dragons, although, hey, shout out to Silver Dragons. I do like his channel quite a bit. Another interesting trend that you can notice here from the pullback in gold that we've seen is this is a chart of the gold spot price, the futures contract uh, price, the paper price, compared to the miners. So we have the junior gold miners there, the GDXJ and the GDX. Those are in ETFs that track gold miners. And you can see that they have performed a little bit under gold itself. But then if you go to the year to date chart, that becomes a little bit more pronounced. And if you go to the 1 year chart, you can see that it's much more pronounced. On a 1 year basis, gold up about 5.74%, and both of the gold ETFs, the gold miner ETFs, pretty significantly in the red. So I think that tells us a couple of things. One thing is that there may be some opportunities here in the gold miner sector, and also, perhaps that investors are thinking that, on a forward basis, the spot price of gold may not remain as high as it is, and so the earnings of the miners may be declining in the future. That could be why they've come under some selling pressure. One gold miner that I discussed recently in a video with Tim Smith, he's the CEO of US Gold Mining Inc. This is one, I thought this was interesting. If you look at their chart, they're one of the miners that's really performed the best since their IPO about a month ago. And really, US Gold Mining Inc., they're really more of like an exploration company. If you watched that interview I did with Tim Smith, it's kind of interesting how they're doing their business model. I mean, they're just looking for deposits. They've got over 9 million ounces in the ground in the inferred. That's if you add up their inferred gold reserves with their measured and indicated. And they're doing some drilling to try to make themselves more appealing as a buyout target. So that was, an interesting examination of that company there, and they have been doing really well. I'm going to go to the chat here real quick. Got a few people saying hi. Yes, hello. Thank you all for tuning in. If you're new to the channel, I do appreciate you joining. Please do, excuse me, smash that like button. And again, like I said, I'm kind of under the weather a little bit today, so I apologize for the sniffles. But the miners, I know it's kind of a polarizing thing. I don't know. I view the miners sort of as like a leverage to the price of physical gold. Now, most of my precious metals holdings are in physical metal, but I do like to hold some positions in the miners because I think that when this whole house of cards really does fall apart, there are some scenarios where physical is going to be the only thing that's worth anything, but there are also possible scenarios where you could just see the spot price of gold and silver be much higher. And in that kind of a case, I think the miners will do quite well. Yeah, it's okay. I'm a little under the weather. As long as you guys don't mind hearing me coughing and sniffling, it's really not a big deal. So US Gold Mining Inc., you can find them at usgoldmining.us. An interesting development on this stock is that they may be getting added to the Russell 2000 in the near future. It's in the next couple weeks, and if that happens, we may see some additional upside price action there. Who knows? I'm not a shareholder in US Gold Mining Inc. However, I am a shareholder in their parent company, Gold Mining Inc. That came onto my radar a little over a year ago, I think. And, I just like the junior miners because I view them as being like a highly leveraged play to the price of the precious metals. And I think that while they are riskier, they also have additional upside potential. And hey, mining companies, they earn a profit, they sell the stuff. And I like what they're doing. I like that they're digging gold out of the ground because if they weren't mining the gold, we couldn't stack it. It is kind of interesting with gold. When you get a gold coin like this, this is minted in 2023. This might have gold in it that was mined last year, or it might have gold that was mined 1,000 years ago. Interesting thing about gold, most of the gold ever mined is still available in one form or another. You just keep remelting it down and making new stuff out of it. Where silver is kind of a different story. Silver is a monetary metal. It is a store of value, but also it is Sorry, I'm laughing at the comments here. It's an industrial metal, so it gets consumed regularly. Scottsdale Stacker asked if I was his dad. No, Scottsdale Stacker, I don't think I'm your dad. I don't think I have any children floating around out there that I'm not aware of. Anyway, maybe I sound like him, or maybe he likes to pontificate about precious metals. I don't know. But yeah, check out usgoldmining.us. They make you getting added to the Russell 2000 very soon. You can check out my interview with Tim Smith. I published a couple of days ago, and you can find out more about that. And just a quick disclaimer again, I'm not a shareholder in this. This is a bit of a sponsorship, though. They are sponsoring this portion of the video, so shout out to usgoldmining.us. Appreciate all of the channel sponsors because they allow me to spend a lot of time creating content such as this, and I appreciate all of you who like to tune in. Now I want to get into the story about the inevitability of the economic collapse here, because the thing is that even if the politicians in Washington decide to raise the debt ceiling, there are going to be all of these, additional areas of economic fallout that we're going to witness. And this is just one example. Excuse me. This is a story from Reuters about how Fitch, the rating agency, is putting the U.S. on a negative watch. So they are considering cutting the U.S. Credit rating. Now, if you recall, in 2011, S&P, another ratings agency, actually did cut the U.S. Credit rating to their second tier rating following that debt ceiling debacle. So we are witnessing that once again. And it's not that surprising that they're considering cutting our credit. I would also consider cutting the credit of the U.S. government. I mean, we've got $32 trillion in debt now, about $187 trillion in unfunded liabilities. No clear plan to balance the budget. All that they seem to want to do and, are focused on is just raising the debt ceiling, borrowing more money so we can pay off the money that we already borrowed, pay off our creditors, with more borrowed money. And I mean, if that isn't the definition of a Ponzi scheme, I don't know what is. So the fact that we're still, AAA credit rated or whatever you want to call it, I'm not sure. The different rating agencies use different, letters to represent it. But we are in, top credit rating right now with Fitch, and they're considering cutting that. And I think that that's probably a reasonable thing to do. And even if they do raise the debt ceiling, it's probably going to happen. And, that's going to make potentially interest rates go higher. It's going to put additional pressure on this economy. It's going to make debt service for the U.S. more expensive. So a lot of negative consequences for that. Another chart I want to bring to all of your attention. I said we had a lot to cover in today's video, and we do. This is the U.S. Treasury's general account balance. This is the one-year chart, and you can see it's been on the decline. So basically, they've been spending down their cash, and now the latest numbers from May 17th, so that's Wednesday of last week, $68 billion. So not very much money when you consider, the kind of expenses that the Treasury is responsible for. And to put this into contrast for you, or context rather, this is the latest Treasury statement, the monthly Treasury statement from April. And you can see that in April, net interest cost alone was $62 billion. Now, you might notice that there's a $176 billion surplus in the month of April, but don't get that twisted. If you go down to the fiscal year 2023 numbers, you can see that we're almost $1 trillion in the hole so far for fiscal year 2023. So, that surplus is just a bit of an anomaly. It's because you're just looking at 1 month there. But the point I really want to draw your attention to is the net interest payment, because that's going up. And you can see that net interest, $364 billion for fiscal year 2023 so far. So the net interest is actually on the rise. And so we barely have enough money left in the Treasury to pay the interest on the national debt, not to mention all of the other things they're responsible for, Social Security checks, for example. I mean, there's going to be a lot of uproar if Social Security checks don't go out. And that's something that, is very possible. Now, I still think that they're going to reach a last minute deal on the debt ceiling. I don't think that they're going to let, the U.S. default on its debt. But anything's possible. I mean, anything is possible. Who knows? Maybe this is all coordinated. I mean, I have no idea. I can't tell you what politicians are doing, except I know that typically they're just trying to get reelected. So, that means they're probably going to raise the debt ceiling because nobody wants to be responsible for the Social Security checks not going out. And if you're just joining, I see there are some new folks in the chat. Thank you so much for tuning in today. Now, this is an article that was originally published in Bloomberg on May 18th, so last week. And I actually saw this on Sean Fu's channel. He did a pretty good analysis of this, so you can always check out Sean Fu. Shout out to Sean. I know he checks out this channel occasionally, but he's got a great channel, does some great analysis. The headline here is Wall Street fears $1 trillion aftershock from debt default. Sorry, that last word is cut off there. I'm looking at this on Yahoo Finance because there's no paywall here. But the gist of this story is that due to the lack of cash at the Treasury, even if the debt ceiling gets raised, in fact, if the debt ceiling gets raised, they're going to have to go out into the market and raise a tremendous amount of cash suddenly by selling a lot of treasuries. And it is estimated that it could be over $1 trillion in treasuries that they have to sell in order to make their, meet their expenses by the end of Q3 2023, which is a huge number of treasuries to sell in that period of time between now and Q3. And Bank of America, their analysts estimate that this massive sell-off of treasuries by the Treasury, massive sell-off of bonds, could have the same economic impact as a quarter point interest rate hike. And the concern is that this sudden supply burst of treasuries could drain liquidity from the banking sector, and we could see another crisis there. So, we've already witnessed in 2023 a financial crisis greater than 2008. I mean, we've covered that on the channel, how if you look at the banks that have failed in 2023, SVB, Signature Bank, First Republic, and the fourth one is evading my memory at the moment, but the four banks that have collapsed this year, the deposits that they held were greater than all of the banks, I think 25 banks that collapsed in 2008. So we are already within an economic crisis that dwarfs that one, the last really big one. And it's looking like it's going to get a lot worse before 2023 is over. If the Treasury has to go in and sell all of these, one of the impacts that this is going to have is it means that rates are going to go even higher. This is another chart I wanted to examine today. I know we're looking at a lot of charts, but I thought this is quite relevant to that previous story that we just covered. This is the current yield on a one-year Treasury note. You can see it's up to 5.242%. That's a pretty good, quote unquote, risk-free yield. However, the reason that rates on the short-term treasuries are rising at the moment is because there is this fear that the US could actually default on them. And it is possible. So it makes sense that rates would go higher. If you want to sell a riskier debt instrument, you need to incentivize investors by offering a higher interest rate. And if you'll notice on this chart that in order to find a time when the yield on a one-year treasury was higher than it is today, you have to go back all the way to the year 2000. So 23 years. First Republic Bank. Thank you, Jeff Tiger Thomas. Appreciate that. I think I covered all the four banks. But yeah, so you've got to go way back to find a time when rates were this high. And it's very possible that they could be moving much higher. And that could mean a lot more economic pain. I mean, when rates go up like this, when you're in a massively over-leveraged economy like we are, where the government is in a tremendous amount of debt, consumers are in a tremendous amount of debt, corporations have a tremendous amount of debt. The New York Fed, they just released the household debt survey, $17 trillion, a new record high. Student debt's out of control. Mortgage debt is on the rise, and mortgage interest rates are on the rise as well. So this is all very ominous. One thing about rising rates that I hear sometimes is that, they're negative for gold or silver. But I do just want to point out that, rates went up very high in 1979. Paul Volcker cranked up the federal funds rate to almost 20%. I think it was around 19. And right after that happened in 1980, we saw gold and silver hit all-time highs that we still haven't really seen again if you adjust them for inflation. So rising rates, not necessarily bad for gold and silver. And also, if you remember what happened in March, back when we had those banks begin failing, starting with Silicon Valley Bank, gold and silver I mean, that was when SD Bullion had a 3 week lead time, and they had to implement that $500 minimum order on physical bullion. So even if we do get a banking crisis, some kind of a deflationary crisis, I don't think that physical metal is going to suffer the way that paper silver will. I mean, paper silver and gold, yeah, those will probably get sold off. Futures contracts, sure. ETFs, sure. Physical metal, though, this stuff is going to become very hard to obtain if there is a further financial crisis. I mean, it's becoming very difficult to ignore now, even if you've been brainwashed by the mainstream financial media and by an educational system that, is basically just a brainwashing system for the Federal Reserve. It's getting very difficult to ignore. I got Jeff Reddy saying hello from Australia. Hi, Jeff Reddy. I don't know if I have any Perth Mint stuff out on the table right now. I don't think I do, but love Australian bullion. So hello to anybody internationally who is watching. Thank you very much for tuning in. Don't forget to smash that like button, folks, because people need to know that we are at risk of a massive economic crisis. Now, another thing that could happen here is that like I mentioned, we're going to see probably interest rates spike up. Even if they raise the debt ceiling, the Federal Reserve, or rather the Treasury, I'm sorry, the Treasury is going to have to be selling all of those bonds to raise funds. Well, they're going to be competing with the Federal Reserve. This is the Federal Reserve's balance sheet. And if we zoom out a little bit more, get back to the 2020 period, there was a little bit of a drawdown during QT from here to here. But then we had the financial crisis begin this year, the 2023 financial crisis in March, with the collapse of those banks. And we saw the Fed have to come in and begin expanding their balance sheet again. And, they weren't buying treasuries, but they were putting them on their balance sheet because they were taking them as collateral for these troubled banks and issuing loans through the Bank Term Funding Program, the BTFP. But they've begun to draw down their balance sheet once again. Now, the balance sheet got very big starting in 2008, but you can see in 2020 during the pandemic lockdowns and paying everybody to not work and bailing out all these failing businesses and all this terrible fiscal policy that we were having to finance, the Federal Reserve went in and they bought ultimately about $5 trillion. Went from $4 trillion here to about $9 trillion in April of 2022. And between those times, they were buying treasuries the whole time, first in a huge spike and then kind of in a consistent way every month. And that is why inflation is as high as it is, or at least this is a big part of it, monetizing all that debt. And so part of their program to get ahead of inflation and to cut the inflation down, in addition to raising rates, they began selling treasuries off their balance sheet and trying to take some money out of the system, basically. And again, then they had to spike their balance sheet up again in the BTFP. Now it's coming back down. But the reason that this is important is because the Fed isn't going to be able to come in and buy these treasury or buy these bonds from the Treasury this time around. I mean, maybe they will, but if they do, I mean, they're in this position where they're kind of between a rock and a hard place, where inflation is just going to absolutely run out of control. This is a page from the Federal Reserve Bank of Atlanta. They have some pretty interesting tools on their site. And this is their sticky price CPI. So the sticky CPI, we'll just read you their definition here. The sticky price index sorts the components of the consumer price index into either flexible or sticky categories based on the frequency of their price adjustment. And sticky is stuff that's slow to change. And another way you might hear this described is the difference between structural inflation and cyclical inflation. Structural would be the sticky form. And basically what those are is things like supply chain disruptions or big expansions of the money supply. Those are things that they're very slow to change. And you can see right now their sticky CPI is at 6.5%. The flexible CPI, that's at 1.9%. So that's stuff that changes quickly. Another way you might hear that referred to as cyclical. So basically what we've got going on here is the sticky or the structural inflation is remaining elevated because that stuff is slow to change. Now the cyclical inflation or the flexible CPI, it was low, it went up, comes back down, and now if it's cyclical, what's it going to do next? It's going to go back up. So that means that we're going to have, even if they just kind of keep going at the pace with QT like they are, it's very likely that inflation is going to remain a persistent problem. But if they start going into the market and trying to buy up US Treasuries and expanding their balance sheet, yes, it could stave off a credit crisis or a bank collapse. It could stave off any number of financial crises, but it means that massive rampant inflation is almost for sure. So we're kind of at a position here where even if the politicians decide to raise the debt ceiling, there's still going to be significant problems right now. Walt Longmire says, should we DCA right now or dollar cost average? Well, listen, I don't tell anybody what to do. I just tell you what I am doing. I just ordered from SD Bullion a couple days ago that 1 kilo bar. I think I showed you in a video. They had a sale and a couple of small things as well. So I'll do an unboxing with that. I am kind of tempted to take advantage of that sale that they've got on those Britannias, though. That I think is probably the best deal I have seen at the moment. They've got these for 379 over spot. It's a sovereign coin. I'm thinking of picking some of those up. Now it will have King Charles on it, so maybe that's why the premium's so low. A lot of people seem to not be real keen on the thought of having Charles on their bullion for whatever reason. But I don't know that the Queen's much better or any kind of royalty or aristocracy. I'm not too into that. But then again, at the end of the day, an ounce of silver is an ounce of silver, and having a sovereign coin is kind of nice. The Britannias do have some features in them to help prevent counterfeits and that sort of thing. So, some advantages there over your average generic round. Excuse me, I'm drinking a little tea there, try to soothe my voice a little bit. But anyway, yeah, there's a lot of signs right now that we could be having further economic problems, some serious ones moving forward, even if the debt crisis gets resolved. And I mean, it seems like everybody in the mainstream, as long as more borrowing can take place and as long as the debt ceiling gets raised, everybody thinks everything will be just fine. But no, it's not the fact that the debt ceiling needs to get raised. It's the fact that we've got $32 trillion in debt and we need to keep borrowing more just to keep things moving along. I mean, that's the real problem. And, I said it before the banking crisis began in March. I've mentioned it several times earlier in the year that, I don't have a crystal ball. I don't know what the thing that's going to break is. But if the Fed keeps raising rates to try to get inflation down because of all the debt, all the malinvestment, the overborrowing that we saw while the Fed had interest rates so low, because of that, all of this debt is leaving our economy very vulnerable and something will break. And I can't tell you what will break, but something will. I mean, it could be another bank failure, it could be the regional banks, it could be commercial real estate. Those seem to be like two popular candidates that people put forth, but it also could be something completely unexpected. Not to mention the other things going on in the economy at the moment, the global economy. You got de-dollarization proceeding along strong. We're going to have the BRICS conference in August. August is going to be a very interesting month, and I don't know what it is, but I have a feeling that August is going to be kind of a pivotal month for 2023. So you can put me on record saying that now. Maybe after saying that, making that forecast, it'll turn out to be a complete snoozer. I don't know, but I think that right now there are a lot of factors that are building, a lot of things at play. And before the end of 2023, I think that we're going to see some major developments that could change everything. Asahi says, Smart Silver Stacker, do you stack platinum? Well, I've got a 1 ounce platinum eagle right here. Yeah, I like platinum. I have a couple ounces. It's not anything I think is, like what I would want to make my core position in my stack. But platinum is, there's not very much of it. It's in very small, scarce supply. A lot of the production of it is in the BRICS nations. So there is some geopolitical components to the speculation in platinum as well. I think like Russia and South Africa together control something like 83% of world production. I read an article on Kitco the other day about how they're forecasting now there's going to be a significant shortage of platinum this year due to increasing demand in catalytic converters in China. China is apparently implementing some additional emissions requirements on their vehicles there. They're getting a little more eco-friendly. And so there's an increased demand in platinum for catalytic converters in China. And I'm sorry, I'm having a hard time getting the camera to focus here. There we go. I, it's a problem with these live streams. Excuse me. But yeah, I like platinum. You know, it's useful for a lot of things in industry. Catalytic converters are the big one, but it's a very efficient catalyst for a number of industrial processes. So yeah, I think that platinum certainly should have a position in your stack. Isn't it twice as rare as gold? Jeff Tiger Thomas says. Well, I think if you look on the periodic table, like the amount in the Earth's crust, I think there's actually a little bit more platinum, if I'm not mistaken. But the amount, it's difficult to mine and extract. So yeah, there's less above ground platinum in refined form than gold by a significant margin. I think that the analogy I've heard is something like if you take all the gold that was ever mined, it will fill up three Olympic swimming pools. But if you take all the platinum that's ever been mined and refined, it only comes up to your ankles in one Olympic-sized swimming pool. So yeah, there's a lot less platinum. And you can see the effect of supply and demand on things like the other platinum group metals like rhodium had a big spike up at the end of the like sometime around the 2000 teens towards the end. Had a big spike up from like $1,000 to $30,000, close to $30,000. Um, there also was the big spike up in palladium after the Russian invasion of Ukraine because a lot of the palladium production in the world comes out of Russia. So there was kind of a supply concern there. But yeah, there's not very much of this stuff. And it's always good to have something that's in limited supply and that is needed for, you know, certain things. I don't view it necessarily as having like the monetary properties that gold or silver do. Not that it doesn't necessarily. I just it's kind of a gray area. So I've heard, you know, this is something that people. I think Mike Maloney says, you know, platinum's not money. It's never been money. Well, there have been some coins. I think in Russia in the 19th century they made some platinum coins, and also, you know, they didn't really start refining platinum until like the late 18th century, I think. They used to just discard it because it was an annoying, like, you know, pollutant to their other ores, and it's difficult to refine. But they figured out how to refine it and extract it sometime in the 1700s. And so it really didn't have time to get the monetary history that gold and silver do. Gold and silver, you know, they were coining them in the Kingdom of Lydia in like 600 BC. So they've been money for a very long time. And if you go back even longer than that, the shekels and stuff, those were used for trade in the Middle East. Those were pieces of silver going back thousands and thousands of years. And platinum just, it wasn't around, so it couldn't do that. But I think that it kind of meets all the requirements to make it money. So yeah, it's definitely a hard asset. And I mean, this is legal tender money. It's got $100 face value. Of course, the melt content is, you know, about 10 times that. But I think it's good to have. I mean, you know, my stacking philosophy is kind of like focus on silver, and then when you see a real good deal or a price drop in one of the other metals, you know, you can snap it up once you've got kind of a core position in silver. But silver is the metal I think that really is the most undervalued and it will benefit the most from the, you know, switch over to a new monetary paradigm, whenever that might be or whatever form that takes, when this next major financial crisis transpires. And it's probably not going to happen tomorrow. Might happen in the next year. Almost definitely, I would say in the next 10 years, we're going to see a major shakeup in the global financial system. I mean, I would bet serious money on that. It's hard to say when it'll be, you know, but it could be as early as August, right? If they announce a new BRICS currency and that somehow catches on and the US finds itself simultaneously in the midst of, you know, a banking crisis or some other form of financial crisis, let's say the wars heat up around the world at the same time, yeah, you know, gold and silver are going to become very important for the global economy and also for individuals who want to protect their wealth. You know, they have been money for thousands of years. They will hedge against the inflation that will likely result when this whole thing starts to fall apart. And we know the Fed will intervene. I mean, or at least there's a high probability that when the next crisis rears its head, the Fed will intervene. They didn't waste any time with that bank term funding program, bailing out the failing banks. So I think that they will, you know, stick to that playbook. And so, yeah, you want to get your hands on physical metal now when it's doing something like pulling back. If we get a real serious pullback because of a crisis, I think that physical metal actually won't decline the way that paper will. But right now, you can get a deal on physical metal. Not financial advice, just sharing with you what I am doing. So I do just want to say a big thank you to everybody for tuning in. If you smash that like button, I appreciate it. Subscribe to the channel. That way you can get notified next time I do a live stream like this. I always appreciate it when you tune in. Stay safe, everybody. Happy stacking. Smart Silver Stacker out.